Hey, what's going on, guys? It's your boy Freddy. Welcome back to the channel. Today I want to talk about one of the most daunting things that's been on the minds of many long-term investors, and that's inflation. Before I get into how we can hedge against inflation and invest in an atmosphere of rising inflation, I first want to go over what inflation truly is. Simply put, inflation is when the price of things we want to buy keep going up. We see this every day with the price of gas or even the price of a gallon of milk. Basically, any product or service is likely more expensive today than it was in the past number of years. This is a natural part of an economy, but when inflation turns into hyperinflation, then we have a serious problem. Hyperinflation is when there's a rapid increase in prices. For example, Zimbabwe dating back to 2007 to 2009 experienced hyperinflation with extreme amounts of money printing. They saw inflation of 79 billion%, and prices doubled almost every 24 hours. That is crazy. This is what destroys your capital and can put your whole country and their population in financial ruin. So we never want to find ourselves in a situation of high inflation or hyperinflation. This is why the central banks and the people in charge try to monitor and keep inflation in a reasonable place. So we do want some inflation. In fact, it is good and healthy for the economy to have some inflation in place. Some positives that come with inflation is that it helps to boost consumer confidence, and it also helps with the level of general consumption. When people realize that holding their money in cash for a long period of time actually reduces their buying power, it pushes people to spend more money, thus stimulating the economy. How inflation works is fairly simple. It comes down to supply and demand. If we look at a specific product or specific service, if we see an increase in demand and the company has a decrease in supply, we're going to see inflation. On the contrary, if there's an increase in supply and a decrease in demand, we will see the exact opposite, or deflation. A perfect example to showcase the effect of inflation is the price of limited edition sneakers. Let's say you get your hands on a pair of these sneakers. When you go to sell them, you may find the prices people are willing to buy them for are far higher than what you may have paid for them. The reason for this high price is because there is a much higher demand than there is supply. There are more people out there wanting to buy them versus how many shoes are being made. So this is why you get an insane price for these shoes. So this is a clear case where demand is high, supply is low, and therefore the price is inflated. The real problem arises when this inflation starts to happen for everyday necessities. So when people have more money, or let's say when there is more money being pumped into circulation, people's confidence is high and they're spending. This of course will create a general rise in the price of goods and services. Now, how do we track inflation? To understand this, you may have come across the term CPI, or Consumer Price Index. So the CPI tracks about 700 different goods and services ranging from food, shelter, household operations, furnishing, equipment, etc. This basket, or CPI basket, contains a broad range of goods and services which represents the broader economy. Because tracking every single thing would be realistically impossible, this basket of things gives us a very good way of measuring inflation. Keeping inflation in a stable range is a high priority of central banks. Here in Canada, the inflation target has been between 1 and 3%. This page that you're looking at is from the bankofcanada.com, and as you can see, the inflation rate is 2.2%. You can see on this chart that inflation rate did drop substantially during COVID. So why are we hearing so much about inflation, and why are investors so worried or fearful of the coming inflation? The main reason is because of COVID. This was really a once-in-a-lifetime event, and the result has been that central banks and governments have had to step in to help us get through it. We have seen records amount of money printing, and this statistic is kind of crazy that in 2020, nearly 20% or 1/5 of all US dollars in currency was actually created. And as I said, when there is more money in circulation and higher demands, it will amount to higher inflation. Because people have more and more money, they're outspending more, and a higher level of consumption is taking place. The byproduct of all of that is inflation. Here's a chart of inflation in the US, which recently just hit a high of 4.2%. When we start to experience inflationary periods, we also get loss in purchasing power. In other words, there's a devaluation of our currency and our money becomes less and less valuable. For example, if I had $10,000 and I put that under my bed and came back after 10 years, that $10,000 has now lost value. If we look at the average inflation rate of 2%, that means that $10,000 10 years ago is now only worth $8,000 in buying power. In just 10 years' time, the value of that money lost 20% of its value, and this is why investing is absolutely necessary. With investing, you're able to mitigate the effects of inflation by purchasing assets that appreciate at a greater rate than inflation, thus leaving you with more money and more buying power compared to simply saving. So if you can't keep up with inflation, and I'm talking about at least match the rate of inflation as the cost of living gradually increases, then realistically you're actually losing money in the long run by saving. An outcome of raising inflation is that central banks and governments will raise interest rates to combat the inflation. What this means is the cost of borrowing money also increases. So if you're out to get a business loan or a mortgage or a car loan, etc., you're going to be paying more for getting that same amount of money. The reason for this is that if they step in and make things more costly to buy a home or start a business or whatever, consumers will be less inclined to go out and spend in the economy. So when an economy is overheating, the central banks will raise the interest rates to try to cool it down by reducing the economic activity, and the opposite would happen if they were to lower the rates. This is what happens when there's a recession, and it is the exact reason why banks dropped rates during the start of the pandemic, so that consumers would continue to spend as the cost of borrowing was extremely cheap. Keep in mind that this does not only apply just to consumers, but businesses are also extremely affected by interest rates. Corporations across the globe depend very, very heavily on debt, and they depend on borrowing and financing for their operations. A simple change in interest rate can result in millions of dollars in more money having to be paid. So how do we invest during inflationary periods? One way of investing during inflation is to own commodities or physical assets. For example, gold or silver. They're considered good hedges to inflationary periods, and you will see that when investors cycle out of the stock market, it is very common that they will go over to assets such as gold. But in my opinion, owning great companies that are extremely profitable is the best hedge. If we understand that inflation is a part of life and it's not just affecting me, it's affecting everybody, that goes for companies as well. These companies are facing struggles, the materials, their costs are going up, but the best companies, the Apples, the Amazons of the world, they're doing so well that though inflationary periods may not be optimal, they are still providing you with an exceptional return. And if you build your portfolio out of these companies, then you're going to do extremely well. On the contrary, if you only own companies which are not making any money, which are in lots of debt, maybe they'll make money down the road, but right now during inflationary periods when interest rates rise, they can really hamper their returns and their profitabilities, and their stock prices will start to tumble because of this. Great companies are still out there, inflationary period or not. They're still generating cash flows, they're still paying out dividends to us shareholders, and they're still producing cash. So investing in the stock market, owning great businesses, and partaking in their gains is the best way to combat inflation. Now I'm going to go over some of my picks for investing in inflationary periods. The first one I'm going to go into is TD Bank. Really, you could pick any of the major banks, RBC, BMO, BNS, take your pick. Today I'm highlighting TD. It pays a 3.78% dividend and is trading at $83 as of making this video. Why I'm believing this is an inflation-resistant stock is because I think bank stocks in general are a hedge against inflation. Banks benefit as they can charge a higher percentage for allowing people to borrow the same amount of money, and the interest that they can collect increases as rates go up. And on top of that, banks and finance companies have a lot of money, a lot of cash which is kept within the business. For example, insurance companies have a massive flow of premiums which they have collected before they have to pay them out. And that money is not stagnant. That would be a huge waste just to keep that money idle. So what they do is invest that pool of money, and as rates increase, these finance companies earn a better return on their investment. And although it may be a marginal increase in their interest rates, when we're talking about millions and millions of dollars, that has a significant impact, and that translates over to profitability for the company. So I'm talking in general, not specifically in TD Bank, but I do like TD Bank as they have exposure to insurance like all banks do. Remember that people don't stop paying the premiums when there is inflation. If you have car insurance or travel insurance or insurance on your home, you're still going to have to pay those premiums that are still pretty predictable even during inflationary periods. So this is why I would consider this a good inflationary hold. Like I said, the banks, especially the big five, are awesome holds. TD in particular has been increasing their dividend by 11% compounded over the last 25 years. Look at that continuous dividend history over the last 163 years. They were here long before I was, and there's a pretty good probability that they will be here long after I'm gone, and I'm just going to ride the waves with this solid, profitable business. They've had a tremendous run and are still trading at a PE ratio of 10.78, which is pretty solid for a bank stock. The second pick that I wanted to share with you is Costco Wholesale Corporation, ticker symbol KOST. Today the shares are trading at $425 USD. Costco has one of the most unique business models out there, and for those who are not familiar, Costco makes a lot of their money from memberships. So unlike other traditional retailers where they mark up their prices and they really stretch their margins on their products, people who shop at Costco come back week after week, month after month, and they get all of their products and they can buy their products in bulk. They're in this habit of going back to Costco again and again. Even if there was a general rise in prices due to inflation, because they have their margins so low, they're basically selling their products close to cost or just a marginal markup, consumers are still happy to shop there. Check this out, Costco has a renewal rate of 91%. So 91% of customers are willing to extend and renew their memberships every year. It's kind of like Netflix, which also has that membership model. They keep their members happy, keep the customers paying, and the company itself has such flexibility in pricing power to slowly but gradually increase prices, and that's where the profitability comes from. And the customers are always in this routine and are happy customers because they're getting their goods at cost or close to cost compared to other retailers. Costco is a wonderfully profitable company, and I believe it has the necessary business model to be a good hedge against inflation during these high inflationary times. Let me know what you guys think of both TD and Costco in the comments down below. With that said, you guys, if you found value in this video, remember to leave a like down below, as it really does help the channel to grow, and consider subscribing for more investing videos like this to come. I also have a Wealthsimple cash link in the description that gives you $25 for simply signing up, which takes about 5 minutes. So remember to use that link, and remember to refer your own links to your friends and family, as that is an excellent way to stack up a few $100s very quickly. I'll catch you guys in the next one.